Welcome back, everyone, to another episode of Ready, Aim, Retire, the show that focuses on securing your legacy with expert wealth management. I'm your host, Rob Kirvan, and today I'm excited not only to be joined by Tony Shore. Good morning, Tony. How we doing?
Good morning, Rob. Doing great.
Tony is a staple here, so everybody knows him. But today we have another special guest. But before I get to our special guest, I always kind of like to catch up with Tony a little bit. Tony, are you a Minnesota State hockey guy? Did you go to
Well,
that? Did you go watch that or?
Minnesota is the state of hockey, right?
Well, I mean the big tourney, the big tourney.
Big tournament.
Well, yeah. I mean, we hear about how high school football is so popular in Texas. In Minnesota, it's high school hockey,
Right.
and college hockey and pro, but mainly high school is huge here. And the big tournament was recently. And this guy, our guest was there. I wasn't there, but I did watch the games on television.
Okay.
Fantastic.
Yeah. I'm a hockey fan.
Because I think like a lot of Gradient people were actually there. You know, like
sure.
you couldn't get a hold of anybody on Thursday. You couldn't no one was answering the phones. It was like, oh, it must be the state hockey tournament.
I was here.
Tony was plugged in.
Yeah.
Tony was plugged in. Okay. All right. So today I'm pretty excited. So obviously we just, went to the podcast 2.0 about 3 or 4 weeks ago.
Yep.
We got this going out on YouTube. We got, all systems are done and we got the new studio done up. And this is our first live guest that we're bringing on. And what I wanted to do is we had a great year in the market last year. And it looks so far so good, right? So I wanted to bring a pro on to see, what their thoughts were. So we deal a lot of business with Gradient Investments up in Minnesota. And I'm going to bring on today Keith Gangl, who's a senior portfolio manager over there, 27 years of institutional experience. But I'm going to let him kind of talk about that. But it's always great to have somebody cut some time out of their day. He's a very busy guy to spend some time with us. So welcome, Keith, and thank you for spending some time with us today.
Love it.
Wow.
Fantastic.
Ladies and gentlemen,
Wow.
Keith Gangl.
I've never gotten that.
What
Never
an
gotten
intro.
that ever. My
Love
goodness.
it.
So welcome.
Thank you. Thanks for having me.
And-
You're fantastic. One of my favorite advisors. Working with Tony. This should be a great show.
It should be. It will be. It always is. Keith, I know you were at the state hockey tournament last week.
Sure was.
First question, did your team that you were rooting for win?
No, but my team, my high school is, produced a lot of NHLers. We're Class AA, which is the largest schools. Only 18 make the state tournament. And Elk Rivers, where my high school is, they actually made the state tournament. They haven't made it in 20 years. They won it back in 2022. So it's fantastic that we go every year anyway, regardless if they're in it or not. But they made it to the quarterfinals. The first game they lost to Edina, who was the eventual champion. Edina's a powerhouse here in Minnesota. A lot of great hockey players come out of there. So it was just a great experience for the kids. And my son's in high school, and he doesn't play anymore, but a lot of his friends were on the team. So it was fantastic seeing kids that my son, skated with, and they were on the team having a great time. It's a big thing. It's, it's a state event. It's on TV. It's broadcast. They fill up the Excel Center. That's where the Wild play. So they're drawing crowds of, 30,000+. It's fantastic.
Why don't you name drop NHLers that went to your high school?
Name
you would know?
Paul Martin was the biggest name. High Note's another name. Otto is another name. Those are a few we've had.
Joel Otto?
Okay,
Joel Otto.
We have Otto. So we have a lot of guys that actually went to, it's been a while. So, Paul Martin was the biggest. That's when they won state in 2022. He was a Minnesota Gopher afterwards. Fantastic all-star defenseman. So he was probably by far the biggest name.
Oh, wow. Okay.
So a little name dropping. We always like to drop a few.
Yeah. That's what I figured. I didn't know it took you so long, but I figured, you know what? I'll give you another opportunity just in case you forgot to do it. But all right. So Keith, tell me a bit about your background. How'd you become sitting here today?
Sure. I'm, like you mentioned, I'm a native Minnesota. I've been born and raised here. As I'm getting older, and Rob, you and I are about the same age, I'm kind of looking, I can see why we hear the snowbirds that want to go down to, whether it's Arizona or Texas or Florida, wherever it is a little bit warmer. I'm starting to get that. But anyway, so I'm born and raised here. I'm still here. I got a couple kids similar. I got 3 kids just like you do. I have a couple in college. Like I said, I mentioned my, son in high school. So how do I actually get here? So I went to a small private, Catholic church Catholic university in central Minnesota. I graduated with a math computer science degree. And so back then I was, 1992, I'm starting to date myself here, but
Yeah, you are.
Yeah, Rob, you're not probably too far different. But anyway, I graduated with a math computer science degree. And coming out of college, I actually went into programming. So I did that for several years, for the first 4 years after college. And again, my background is math, computer science. I'm very strong in math. That was kind of where I like to be. And so that's what gravitated me towards investments. So I've been doing investments, like you mentioned, for 27, 28 years. It's been a fantastic transition. I used all the skills I learned in, programming to also transition that into investments and kind of building different models, kind of structure, having a process that helped my investment process. And now I've been a portfolio manager here at Gradient for the last 6 years. I've been doing this, prior to that, I was at Lutheran Brotherhood / Thriving for 25 years. So spent a lot of time here. I worked with our president, Mike Binger. He came over here about 12 years ago, and, talking him on and off, he said, Keith, why don't you come over here? And finally 6 years ago, I did. So that's how I'm here right now.
And was that a positive move for you, Keith? Or
are
you happy with it?
It's been fantastic, right? I'm on podcast now, working with you, working with Tony. The thing that, the difference between, institutional investing over at Thrivent compared to what we do now, it's the same process. I do the same type of things I did over there, but now I get to work with advisors, and I also get to work with clients, which I love. That fact is, as a portfolio manager, and, I sit at my desk picking stocks all day. What does this mean at the end of the day? Obviously, you want good stocks versus bad stocks, but it's nice to be able to talk to advisors and say, how are your clients doing? It's actually, I get on the phone with your advisors or your clients as well and say, what's your plan? What do you need to do? And it's a great feeling to be able to see where that money go and how important it is, how people helps them retire early, maybe helps them build a legacy for passing it on. So it's great. I love it being here.
And that is like a strong thing. And the reason we partnered with Gradient probably, I don't know, 10 or 11 years ago, maybe 12 years ago, but and that was kind of the pull for us. The pull for us was exactly what you said, is that the portfolio managers are available. You guys come to our events, come out to the events, speak, talk to our clients and really understand like where they're trying to get to, whether you're managing your portfolios or just speaking in general to the clients. People appreciate that, because guess what? That doesn't happen anymore. I can't call, somebody at Fidelity and get the portfolio manager on the telephone. That's just not going to happen ever. And coming to an event, no way, so that's part of I'm a relationship guy. And when I saw that way back then and watched you guys grow as we've grown, exponentially over the last decade or so, is just seeing that and seeing the willingness to do that. It's not pulling teeth. It's like, hey, can you guys come down to my, my summer beach bash or whatever it happens to be. And you're come on out and hang out and whatnot. So I think that part is fantastic. I also saw, Keith, that you've been in Investors Business Daily, Bloomberg, Wall Street Online, Routers, and a ton of other local and national publications. So that's got to be pretty exciting.
Yeah, it's very exciting. We do a lot of TV as well. So, do Reuters TV, I do Bloomberg, various things like that. So it's nice to get out there. The reason we do it is because the media appreciates our opinion. So it's nice to get out there and share it. And again, so that working with you guys, it's great. Now you can say, hey, by the way, let's get Keith Gangl on the phone. He was just on, CNBC or Fox or Bloomberg or Reuters, whatever it was. And you're like, okay, let's talk about what are your issues. It's fantastic working with you guys. You do a great job working with your clients, setting up their plan. Now your clients are always going to have questions. We're always there, to answer them. Now going back to, 25 years ago when I worked at Thrivent, again, do the same thing I do, managing money, that kind of thing. But we would never, ever talk to any of our field force, or certainly wouldn't even talk to our clients, which again, that's probably frustrating. So like you said, you can't pick up the phone and say, Keith, why are you buying or selling stock? What are you thinking about the market? And right now we have those conversations. I like to have it. We like to have informed clients. You do a great job of informing them, and we like to help out where we can.
Right. And I think that certainly does go a long way. Now you at Gradient, so you manage a few different portfolios, right? Can you tell us about the ones you manage and kind of, what sectors they're in and kind of what they're supposed to do?
Yeah, the three main ones are the core select portfolio. That looks like the S&P 500, right? Everybody's familiar. When people hear about the market, what they're usually referring to in the media is the S&P 500, right? So instead of owning 500 companies, the core select portfolio is going to own anywhere from 50 to 80. Right now, I own 55 names, right? There's plenty of names I don't like in the S&P 500, so why should I own them? There's plenty of names I like a lot that I'm going to own a lot more than the S&P 500 owns as well. So I'm an actively managed portfolio. It doesn't mean we're trading daily. I mean, our turnover is relatively low. It's probably about 25%. So that's the elevator pitch on that portfolio.
Okay, so
Again,
wait, so explain that to me. So when you say you have a 25% turnover rate, what does that actually mean?
that means how we're buying and selling. Say if we own 50 stocks, if we sold all 50 and bought 50 new stocks, that'd be 100% turnover. So throughout the course of the year, probably about 25% of the portfolio gets turned over, or at least, added to some, or maybe take some away of, for prime examples, we owned Apple for a long time. In the last 3 to 6 months, we've been selling it down because we think valuation's getting a little bit stretched. So we actually sell it all a little bit, and then we use those proceeds to buy something else. Maybe we buy an AMD, which is a semiconductor company that's kind of like an Nvidia, and that stock has done very, very well.
It has,
That's
yep.
that's the kind of stuff that we do as active managers. Now, I just want to point out that I'm not turning over the whole portfolio, right? Because those also have, like tax consequences as well. Just so you know that typically the industry average is probably around 30 to 40%. So point being is I generally buy companies and hold them. I don't want to be turning them over all the time as well. So that's the core select.
So if I started with 55 companies in January, I would anticipate that throughout the year, 12 to 15 of those would disappear, and you'd have 12 to 15 new ones, basically.
Correct. Yep, that's exactly the way it is. And right now, our range is 50 to 80. I think I've been running around 55 to 58 since we started the portfolio, which is a little over 5 years ago. So it's a pretty tight range. Now, if I was really worried about market conditions and kind of things falling apart, I would probably start buying more names. They have a little more diversification, a little more safety. That's how we kind of manage the portfolio. Vice versa, if the things are doing, very, very well, we may peel back some things and be a little more concentrated in names that are more defensive.
Okay. And the core select is very popular. We have a lot of clients that use it, love it. It's done very well, hasn't it?
Yeah, it's been a fantastic.
You might as well pump your tires, Keith.
Just a little, yeah.
Don't get into numbers, but it's done particularly well.
Yeah, yeah. So last year, it was we were more positive on the year. If you remember going back into last year, everybody's worried about a recession, right? We had high inflation. 2022 was coming down. Everybody thought was calling for a recession. Most of us here, I certainly was a lot more positive on the overall economy, and so that's how I positioned my portfolio. So we had a great year last year. I think we outperformed the S&P 500, which, like I said, that's kind of what we kind of look at to see how we're doing, kind of grade ourselves. We think we outperformed by like 5%. This year we're off to a strong start again, up by over 1%. And markets again are off to a strong start themselves. I think as of year to date coming into today, the S&P is up about 8.5%. We're up about 9.5%. So we're continuing to chug along. We like the names we have. We like the positioning, and then we can talk about the markets here a little bit when we get to that. But that's kind of how we think about the core select. Again, I'm always looking for every day I come in. I'm looking, is there a way to upgrade my portfolio? Should I be buying something I don't own, or should I be selling something that I think is too rich in value? I'm constantly also talking to people about when I just go out and about and just kind of like, how's your business? Trying to get different data points. I'm a big believer in that. Just trying to put the mosaic together.
A little grassroots, Keith.
A little grassroots, right? We do a lot of reading. Obviously, the Wall Street analysts, and we get all the research, and we can pick up the phone and talk to them if we need to. But I also like to hear people from on the street, especially in the Midwest. It's a little bit more of kind of general common sense than you're hearing from some of the coast, where some of the stuff gets pitched out like this is what's happening. Well, that's maybe just happening in New York or California. It's not happening across the rest of the country. So that's where we kind of put in the heartland. Exactly. Yeah, so that's kind of where we put all the different data points together, and that's kind of how one of the ways I pick stocks.
And the point this out is I read a thing maybe a week or two ago that only 20% of portfolio managers last year actually beat the S&P 500. So if you're listening to this or watching it on YouTube, you're looking at, one of the 20% that did it. So that's actually pretty impressive, because it's
very impressive.
And going down that same, we just put something out, I think a couple of weeks ago, is since inception, it's been a little over 5 years where the core select is beating the benchmark, which is hard. Over a 5-year period, I think that number drops to like 10 or 12% that people have actually beating the S&P 500
over a longer period of time. Sure.
over that 5-year period, right?
And how's the core select doing?
We're outperforming, so we would be that camp of that 10 to 15% of talking about pumping your tires.
Wow.
That's kind of
right. No,
wow.
But I like to hear that. Yeah. We invest in that. We have many clients, like hundreds of clients in it, and I like to hear that. I could think like, if you do it over a 5-year period, that's pretty impressive stuff. Because not that with the clients we deal with, there's obviously things that we have to look at with risk and what they're looking at. So it's not like everybody would have a core select because it is a full equity portfolio. But the ones that do, or is that part of an allocation? Obviously I noticed last year and over the past several years how well it's performed. So that's pretty impressive stuff. What other ones do you?
So the other two are the G33 is our all growth portfolio. So that's going to be all growth stocks. There are going to be 33 names in that portfolio, which is a little different. It's actively managed, just like the core select, but it's going to own 33 names. And there'll be 11 large cap names, roughly 11 mid cap names, and 11 small cap names, all growth stocks, right? So I'm not screening like the G50 or all dividend paying portfolio that screens on dividends. It's got to be above the S&P 500.
Sure.
I don't have that restriction with this portfolio. I'm looking for growth though. So a lot of these names that did very well last year, you got your Nvidias, your Microsofts, your Meta, those can all be found in the G33. And that portfolio, S&P was up, I think it was 25, 26%. Core select was 31, outperformed by 5%. But the G33 was, I think, up 45% because it owned all those names. Now, mind you, the year before was a bit of a mess, right? It's just, full disclosure, right?
Perspective in there because it was tough.
It was tough,
2022,
right? Yeah. So when growth stocks are doing well, the G33 portfolio, but that also did, I think it was outperformed by maybe 15, 16% relative to its growth benchmark. So we had a very good year. Again, we were more positive where the market was, worried about recessions. We weren't. So I think that's how the positioning helped us there. We owned a lot of these big names that were big. I mean, Nvidia up 240% last year. That's a fantastic name. Metas, those are all big names. If you go back like a year and a half ago, those are names, especially like the Metas of the world. They were, the Googles, they were all under pressure. They were left for dead. It's like they were trading at such cheap multiples. And that's when, I didn't know when the bottom was going to be or when they'd turn around, but those are kind of names that we add. And that's kind of my investment philosophy. I like to own, high quality names that go on sale. And that's when I really want to start loading up on them. And then vice versa, when they get a little expensive, then you got to start trimming them back.
Yeah, buy low, sell high. What a novel idea. The average investor, people who do it on their own, the majority of them don't. They end up buying high and selling low. That's the difference.
That's really true. Yeah, that's really true. And when you look at like average investor stats, and when we look at like long-term trends, it's considerably lower than almost every asset category because you get the emotion in. Where a guy like Keith, you can tell he has zero emotion.
Zero. I'm out. I'm just flatlined here.
Right. No. Oh, there he is. Yeah. But no, it's not like I'm just joking. But when it comes to investing, he doesn't get emotional with it because he's looking at companies, like he said, high quality companies. He's looking for growth. He's looking for where the next opportunity is. Where a lot of times an individual investor, they see something on the news. They buy it, it goes down, they panic, they sell, and then they start all over and do it all over again. Or when times get tough and it's bouncing around a little bit, like if we look like a year, like last year, like 2023, coming into November, the market was barely up. And we went through big swoons down, through the summer where the market goes down when people are selling, so when they're selling, I think what I'm hearing Keith say is now he's looking for the opportunities to go, okay, what's on sale right now? Just like when we go to the store, we want to buy stuff on sale, so he's looking for stuff on sale. And I think that's why it works so well when you use professional asset management, because they take the emotion out. They don't look at that. They look at the fundamentals, which I think is why those two portfolios in particular have been so successful over time.
Yeah, you nailed it. I mean, been doing this a long time. So it's like I really know, like in 20, just back to the COVID shutdown, back in 2020, the market sold off, 35% in a matter of 5 weeks. We're getting, calls from advisors and clients all across the country. It's like, oh my goodness, the economy's shutting down. It's like, we didn't know exactly what was going to happen, but usually when I get that pit in my stomach, that things are really, really bad, that's the time when we still need to be, calling out to our advisors and calling out to our clients, which is what we did, and said, no, we don't know what the bottom is going to be, but this is a time if you have extra money in the cash on the sideline, that's the money you should be putting in. As a portfolio manager, I'm going to get less defensive. I'm going to get more, offensive. I'm going to buy these names I think they'll do better in the rebound, and that's exactly what happened, right? Because the market actually went up 100% in the following year. So we don't know what the bottom is going to be. So that's one lesson I've learned over, these almost 30 years of doing is time in the market is more important than trying to time the market. It's so difficult to try to time it. That's why you're right. I do take out the emotions on things, and I don't go, oh my goodness, everything's going, bad. I'm going to pull everybody out. Instead of being core select, having 55 names, I'm going to drop it to 30. I'm going to have half cash because I know the market's going to pull back, and then I'm going to have all this cash on the sidelines and go back in. That's not realistic because no one can. I mean, it's often, I've been doing this for 30 years. I can't, no one can time the market. If you did, you'd probably be, what Bitcoin living on some island somewhere or whatever you're doing, right? It's just like, it's impossible. Hard. It's impossible to do. So that's why you do a great job. You set up their, plans up front for your clients and say, here's your plan, stick to it, right? We may have to make some changes based on your needs, but do we have your income bucket need filled? Check. Yep. Whether it's Social Security, pension, annuity, green money, whatever it is, that's, fine. And I'm sure you got calls back, when the COVID shutdown was happening, it's like, what's happening in the market? And then you go back and say, here's your plan. Are you meeting your income needs? Yes. Okay. You don't need to do anything. It's like, this other money that's supposed to grow is not growing right now, but give it some time and it will. Again, you're meeting your income needs. Is anything changing there? No. Okay. Let's take a little breather here. Maybe stop looking at your statements for, a couple of weeks, couple of months or whatever it may be. And then boom, a year later, the market's double. So all that equity exposure they had, again, you got well-diversified, clients. So I would hard guess that you have any clients that's 100% equity anyway, because most of your clients are retired, right? So there's a mixture of needs.
And I don't have too many clients to be honest that are panickers.
Yep.
I could count them on this hand, and those are the ones, that when it gets shaky or they're freaking out a little bit, no matter how many years they go through, people are kind of just wired that way, and that's fine. But for the most part, people go by your strategy, Keith, which is, buy it, trust in the process, trust that the people managing my money know what they're doing. I love that you said you're a math guy. Everyone wants a good math guy behind the scenes, like doing it. I think that's important. But just making decisions based on fundamentals, what we're forecasting, what these companies are forecasting, and that's going to breed success. You guys have the access to that. You're doing it all day, every day. I don't know how an individual could ever feel that they could take on a company, like that. Like I've never understood why, when I go, if I'm doing taxes, I can do taxes, Keith. Obviously I went to school and everything, but I use a CPA, and the reason I use a CPA is because that's all they do. That's all they do all day, every day, and they're going to know things. And that's why we trust in Grady Investments, guys like you, and it proves it in just those two portfolios right away, like being ahead of where we want to be. So I think that's fantastic.
Yeah, and the other third portfolio is a Contrarian Choice Portfolio. So this is a little bit different. This is actually we created right when the bottom of the COVID. We actually started that portfolio on March, I think 31st. I think the bottom of the market, was March 20th. So we missed it by a few days. But point being was, nice thing at Gradient, versus working at a big company is like we saw the market opportunity. The market was selling off aggressively. It's like, how can we take advantage of this? So as a portfolio manager, like I said, I was upgrading the core select. I was upgrading to G33, trying to say these are the names that should perform well in a snapback. But how can we really have a portfolio that does well if this is truly going to be a snapback? And that's we developed literally in a matter of a couple of weeks the Contrarian Choice Portfolio. So this is a highly concentrated portfolio. It's going to be by high quality names that are out of favor. It's going to only have 20 names in it. So again, highly concentrated. So the position size are going to range anywhere from 2% to maybe 10%. So so this portfolio is going to have, very few names, and it's going to move a lot of volatility. So it should be, more of a high beta portfolio. But anyway, when we created that portfolio and that was up 75% in those following 9 months to finish the year. So
wow.
That's the kind of, so a lot of volatility. Last year it outperformed, the S&P 500. This year it's down a little bit. Again, as the market gets more narrow and these, the names like the Magnificent Seven are driving the overall market, I'm going to own names that are out of favor. And so those names I don't own those magnificent seven or names, right? Because I'm going to
Right.
own names that are out of favor. And so when the market starts broadening out, which is starting to do a little bit, then it's an opportunity to look at like the contrarian choice right now. But of the rank order of the three, I would still, I like the core select. It's well diversified because I can own growth names. But if I think the market's going to be shifting more towards value, which it potentially is a little bit here, I can shift some of my growth names into the value side of things. The G33, I just like growth long term. That's we talked a little bit about what I did at Thriving for 25 years. I worked with Mike Binger on a large cap growth portfolio for 6-7 years. And I also managed a small mid cap growth portfolio for 10 years. So that's kind of my background.
That's
and
your wheelhouse.
That's my wheelhouse. And, just kind of like hockey's your wheelhouse, growth stocks are my wheelhouse. That's, that is, I think over time, and it's kind of proven that for the last several decades that growth stocks do fantastically well over time, right? Value has its day in the sun, certainly at certain periods of time, but I like these companies that are innovative and continue to grow market share. And that's generally what you find with growth companies.
And the contrarian's interesting because it just gives a client an opportunity to have something that's kind of going against the grain.
Yep.
I wouldn't use the word hedge, but you're kind of doing that. You're saying, listen, here's, I don't even know if this is in there, but here's Target Corporation that got killed and, kind of for no reason, but a great company, great outlook. We're going to grab that at a deep discount and wait. And when they become in favor, look out, we're going to have lots of upside.
And that's exactly right. Target is in there. We bought that a little early, then it dipped down more, but then all of a sudden it's had a fantastic run here. So it's a really good stock for us. And you nail it. That's the kind of name you'll find the contrarian choice. Medtronic's another one, just to throw out a name. It's a high quality med tech company here in Minneapolis as well based. But they've been, mismanaging a little bit on execution last year. I think fundamentals are turning there. Valuation is cheap. Those are the kind of high quality names you're going to find. And you're going to find, they'll be bigger weights. They'll be 5-6%. So that's a pretty big sizable weight. And like I said, there'll be some volatility, but over time we expect that portfolio to do well.
So you only buy Minneapolis-based companies?
Yeah, it seems to be the case, at least in how about Starbucks is another one recently. Has been
okay, all right. So we got out of the region.
That's certainly not in Minneapolis. And I got out of the state hockey tournament. I figured out we need to get something a little bit outside of the state.
Okay, I like that. Totally contrarian. Totally contrarian. Let's see. I have one last question for you. What do we think? Market, like you just said, it's kind of been on a tear so far this year.
Yeah,
we're in an election year. Tony and I last week had a great show all about elections and stats and all that kind of stuff. What do you think, like the market going forward this year? Like, are you feeling we're kind of there, and we're going to do a little sideways, or do we still have some runway?
Yeah, great question. Going into this year, we're still more positive, and the reason we're positive is because unemployment's still low at 3.9%. When people have money in their pockets when they're working, they love to spend, and they drive the overall economy. Consumers drive about 2/3 of the overall GDP growth rate. So again, unemployment at 3.9%. The 50-year low is at 3.3%. So we're barely off the 50-year low. 3.9 is almost considered full employment. People are working. Earnings are still fantastic. Earnings growth for this year is expected to be about 10%, actually 12%. And
wow.
I think, and so that's a pretty aggressive number. We think it's going to be probably more of that 8 to 10%, but we just got done with Q4 earnings, and they were really good. So that maybe that 12% number is going to be right. And if that's the case, that's a positive backdrop as well. GDP, I mentioned, GDP is growing as well. That's, that any range of that 1.5% to 3% a good range. Coming into, going back about 3-4 months ago, was at 0.8%, GDP growth rate for this year. Now it's ratcheted all the way up to 1.6% for the full year. So again, that's kind of that range of 1 to 3.5%. So we like it. So it's a positive. Now the negative here is valuation. The market, to your original question though, is market started off strong here. We're up, like I said, 8.5% year to date. We thought the markets this year would be 8 to 10. Earnings been a little bit better. Things are a bit better. So we can probably kick that up here a little bit. Maybe it's, low teens kind of returns, but I wouldn't be surprised if we see a pullback here. Market's getting stretched on valuation here a little bit. We've been making some adjustments here as well. Like I said, we sold down some of these winners like, Apple a little bit, and we sold down some of that AMD I talked about earlier.
Yep.
We those are high flying names, valuations getting stretched. We kind of sold those things down and kind of rotate into some names that are a little bit more reasonably valued. Buy some of these consumer names that we think, like a Starbucks I just talked about. We think that's, it's a cheap stock relative to historical. It's cheap relative to the market. Starbucks still around, even though you and I talked about it a little bit before coming on here, is we both gave up coffee here in the last, 4 months. So,
Right,
that's probably 2 less Starbucks customers.
No, I would
out
never
there.
buy it at Starbucks. I'm going to tell
No,
you that right
you and
My
me either.
kids
So I
would.
guess they're.
Yeah, my kids would. They don't have
Yeah.
any money, but they would do that. But I
Yeah.
certainly,
Sure.
Yeah.
I can't pay $6 or $7 for a coffee. Never have, never will. But
Yeah.
they're always busy, Keith. So it's probably a great company to own.
No, you're my kid's the same, as yours is. I got a couple girls in college. They don't even drink coffee, but they'll just go there and spend $6 on some. I have no idea what it is, but I
Some
just
crazy
cringe
herbal tea with some- right.
every time I get the bill. So
Okay. Well, anyways, Keith, first of all, I want to thank you for coming on. I know how busy you are. Just to come on in, I could keep this show going for another like an hour, but people will stop listening. You're shocked. They will stop listening. We don't want them to stop listening.
no, we don't want that.
We don't want that. But I want to thank you. I really appreciate you carving out some time for us today. Tony, as usual, less talking today, so we'll have to ratchet that up.
Forgot he was even here for a second.
And appreciate you hosting and getting us all organized.
Well, Keith today was a huge get for the show.
It was.
Rob, before we go, let our listeners know how they can get a hold of you.
Sure. Give us a call direct, 630-780-1099. If you want to meet and just do an in-person complimentary review of kind of where you sit right now, give Natalie a call. She'll book a time. You'll meet with me one-on-one. We'll take a look at what you're doing and then we'll go from there.
All right. Give that number one more time.
630-780-1099 or go right to apadvisorsgroup.com. You can get all the information on there, and this recording will also be on there. So that's great.
All right. That's great. Well, thanks, guys and listeners. That does it for today's episode of Ready, Aim, Retire with our host, Rob Kirvan.